Well, happy October, everyone. Welcome to the first Lear Market and Strategy webinar of the fourth quarter of 2024. My name is Tom Steinley. I'm Director of Business Development at Lear. We're joined today, as we are each month, by our host, Jim Warner. Jim is the Head of Research and Co-Portfolio Manager at Lear. For those of you joining us for the first time, and I know there are several, the intention of these webinars is twofold. First is to provide some insights about what's going on in the market and the economy. And because we do all of our own research, our insights are typically a little unique. But more importantly, the reason we do these webinars is, and what makes us different is tying what's going on in the market back to our strategy. How does what's going on in the world affect your portfolio? We manage a concentrated portfolio of high conviction securities based on long-term irrefutable themes. Because we own only 30 securities, it's easy for clients to know not only what is in their portfolio, but more importantly, why they own each position. And these client-approved webinars help in that regard. Before we get started, I just want to encourage all of you on the call to ask questions, and you can do that through the Q&A box at the bottom of your screen. And I also want to remind you that we will be following up by sending you the compliance-approved replay of this webinar and also Jim's slide deck. So with that, Jim, let's jump right in.
Great. Thanks, Tom, as always. And thank you all for joining us today. So as per custom, I'll share my screen with you. So this month's webinar is entitled "The Fed Put is Back." And we'll talk a bit more about what that means because we haven't heard that term really for a number of years. And so this is kind of an interesting scenario that we're in right now with the Fed now moving into this easing cycle. So if we look at what the Fed did on September 18th when they held their meeting, obviously they made their very first rate cut in this cycle. And they reduced the upper end of the range from 5.5% to 5%. Now, this is an unusual step, historically speaking. A 50 basis point move historically was only used in emergency situations. So during times of the pandemic, where the economy just fell out of bed because it was locked down, it's happened. We've seen 50 basis points after the 1987 market crash and other crashes in the market, but we've rarely seen it when we actually had an economy that's doing pretty well, which it is right now. And so Chair Powell was pressed on this. And by the way, one of the terms you've heard in the past is we call it the Fed's bazooka, right? When they bring out the big guns, a 50 basis point move has had that kind of effect, psychologically mostly. As we'll get to in a bit, there's a lag in the economic impact. But so Chair Powell was asked about this during his press conference and on whether this move constituted an admission that they are late to the game to cut. And remember, this is the key concern that we have, is that the Fed has been too restrictive on monetary policy for too long and is going to be fighting against an economy that really wants to weaken aggressively. But to his point, he said, we don't think we're behind, but I think you can take this as a sign of our commitment not to get behind. So it's a strong move. And indeed, it is a strong move. And I think more importantly, he went on to say that the Fed is very hyper-focused on the labor market, which has been softening, and has essentially pledged to lower interest rates if need be, if the labor market gets too soft, or if we start to see slowdown in consumer spending. So we have really entered into a new phase, not just an easing cycle, easing part of the cycle, which is in fact new, but we've got this new phase of the Fed put is back. And we'll talk about that here in a bit. So as monetary policy starts to ease, where are we going? And remember, we've started at this very tight, we've been at this very tight level. So right now, if we'd add a column to this bar chart and say, where are we today? We're at around 4.8% is the Fed funds effective rate. And these blue bars are essentially what the market is pricing in for Fed futures at each of the next several Fed meeting dates. And so what you can see by this is that the market is assuming that the Fed is going to gradually ease down to what would be considered a neutral level. So where monetary policy is neither too restrictive nor too loose. Now, there's a bit of a range as to what economists think neutral really is, but it pretty much is around, say, 3%. Could be plus or minus 25 or 50 basis points. But the bottom line is that that's the direction that we need to go to get back to neutral monetary policy. And so now, as you can see, and one of the things I actually added into this graph is these green bars. And this is per the Fed's own projections. So the Fed believes that we'll exit this year with a Fed funds rate of 4.4%, which obviously implies that there's going to be another 25 to 50 basis points of cuts by the end of this year. That's obviously a little bit higher than where the market is. So the market's a little bit more aggressive in its assumption. And then you can also see that their projection for the end of 2025 is 3.4%, and the market is at 2.9%. So again, the market is a bit more aggressive. We've seen this movie before. If you recall back to when we entered into this year, the market was super aggressive on expecting lots of rate cuts during this year. And obviously, we didn't even get the first one until just this past month. So it's very likely that the market is going to have to readjust its expectations. But just like the market will be data dependent, the Fed will be data dependent to actually determine the pace of these rate cuts as we get back to that neutral level. Now, obviously, if we have very aggressive rate cuts, that's probably going to mean that the labor market and the consumer spending is rolled over. And that could be a problem. So for now, the soft landing, sort of scenario is a gradual set of rate cuts throughout the year. Now, how it actually plays out, again, is going to be data dependent. So one of the things that I mentioned before is just how restrictive monetary policy has been. And I've shown you now this graph on a number of occasions in previous webinars, but this is our way of measuring how tight monetary policy has been, and to look at it on a time series back historically. Now, what I've done here is I've just take the Fed funds effective rate, which, as I mentioned, is now about 4.8%, and I've subtracted out core PCE, which is the Fed's favorite metric for inflation. And what you can see is that right before this cut happened, we were basically at a restrictive level that we hadn't seen since right before the Great Financial Crisis. And prior to that, the last time we saw something monetary policy this restrictive was right before the dot-com crisis. And I'm not suggesting that we're going to have a crisis, but it gives you at least some perspective on just how tight I believe things really have been. Now, in the short run, this cut of 50 basis points, and then let's just say we get another 25 to 50 through the rest of the year. This is not a sort of immediate panacea to an economic slowdown, right? If you recall, Milton Friedman, said that changes in the Fed funds rate have a, quote, long and variable lag in terms of its economic impact. So while there are some immediate repricings that happen in terms of like loans and things of that nature, really, it takes a while for Fed cuts to really filter through the system. So so that being said, we're going to have to watch very closely, again, still how the labor market evolves even as these rates are cut. But in the meantime, what these lower rates do is they feed the bull market. And so while we have this a very unique setting right now where we are getting lower interest rates, and while we still have a sturdy economy and a Fed that has essentially said, we got your back. And what this is doing is it's putting a floor effectively under the markets and lifting them. And you've seen this now across, essentially all of the stock markets. What's interesting as we sit here today is that, remember, beginning of the year, we had this rapid outperformance by the NASDAQ, principally driven by NVIDIA and some of the big AI names. Now you've seen the S&P 500 catch up. Both indices are up a little over 20% today as we sit here today. Meanwhile, you've had the equal weight index and the Dow Jones Industrials. Obviously, these are indices that have more cyclical names in them, have started to play catch up. And honestly, that kind of broadening of the market is a good attribute and a supportive attribute for risk markets. The other thing that's happened is that we started to see lower long-term interest rates, even before the Fed cut rates. And this is lifting up the fixed income market. So as you can see on the chart on the left, as the economy has started to weaken, and we've definitely seen a lot of data out there that is showing weakness. Just yesterday, the ISM manufacturing numbers came out. They were very weak. What's hanging in there are the services. But the manufacturing's weak. We've seen, some weakness in the labor market, and that's helped bring down long-term interest rates. And we've seen them fall from 4.7% to down around 3.7-ish, 3.8 today. Now that 100 basis point move has created a boon for bonds. And if you look at the chart on the right, that's the US aggregate bond index, which is obviously the kind of the representative index for the fixed income market. It's up 8.5% or so since May. So it's been a really nice lift for bonds, and honestly, very important for investor portfolios, particularly conservative ones that have struggled to get bond returns for the last, 4 or 5 years. You now have actually started to see a very productive use for bonds in portfolios. And we've been talking about this, if you've been paying attention and watching these calls, now for months, that bonds are really adding value to investor portfolios. So let's now dig into portfolio strategy. And so how do we think about now that we're on an easing path? And the first, kind of words that come to mind is don't fight the Fed. So if you recall, Professor Martin Zweig coined the term "don't fight the Fed" in 1970 to explain the really strong correlation between Fed policy and the direction of the market. And basically, the way to think about this is that easy monetary policy generally drives a limited risk and lower volatility, and therefore higher markets. Now, we don't have easy monetary policy today. We're actually just coming down from very restrictive levels. But I think the same point can be made, which is that as interest rates come down, investors will be more willing to take risk, and you will see lower volatility in the markets, and that should push up indices. So that's a good positive. It's a positive thing. Then we had Fed Chairman Greenspan. If you remember back to his reign as Fed Chairman from 1987 to 2006, he sort of increased this notion of don't fight the Fed by adding the use of very aggressive interest rate cuts to support troubled markets. So if you recall, in 1987, when he came into the Fed, we had the stock market crash that fall. And what did he do? He immediately dropped rates, fairly dramatically. You saw that again after 9/11. You saw it also after the long-term capital management blow up in 98. And then you also saw it after the dot-com crash. So this use of dropping rates when the market gets into trouble became something that the market could rely on. So this notion of a put, which is obviously protection, downside protection is what essentially a put does, has really came into play during that period of time. Now, Powell, on the other hand, has probably added a new twist to this Fed put. And you can see it in this comment that he made during his press conference last month. He said, if the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. So what he's really doing is he's saying, okay, we are, and this really is more, I think, an issue with respect to the labor market right now, because while we see some disinflationary forces at work in prices, we aren't seeing deflationary, not much in terms of deflation. And that's really where the Fed would get nervous and drop rates pretty dramatically. So I think the real key focus is on the labor market. And if it softens too much, the Fed will be there with rate cuts. So our takeaway from this is that we still need to be vigilant in observing the economic data. And we need to expect that there will be some market volatility, whether it's, the expansion of the war in the Middle East, with Israel and possibly Iran, whether it's election-related volatility, wherever the volatility may come, we still need to be observant that could happen, but we also now have some confidence that the Fed put exists. And so this means that overall, we still want to lean risk on. So to put that into kind of a portfolio context. Now, what I want to do is go through a couple of stocks that are in our main portfolio, Global Vigilance, that have done really quite well. And in light of everything that is going on, we actually are at a point in our portfolio where we're basically reaping what we have sowed. A lot of the themes that we've talked about with you over the course of the last few months are really starting to kind of come into their own. One of them, for example, one of these themes that we talked about were the next wave of artificial intelligence winners. So obviously, NVIDIA has been really the focus of AI for this year. It's been a phenomenal performer. We still own it. But how about the next wave of folks, the next wave of companies that will benefit? And one that we did a bunch of due diligence on and figured and believed would be a winner is Oracle, which is a leading provider of cloud-based software solutions and also a leading hyperscaler or data center operator. And this past, you can see in the red circles where we bought this stock back in kind of the April, May, and June timeframe. And we've had this nice pop thanks to a good quarter that they just announced. And it's very clear from their commentary that they're at the very early innings of benefiting from artificial intelligence. So that one's been a great one. The other artificial intelligence name that we moved into recently is Micron, which is a leading memory chip manufacturer. The market really had overlooked this company. Micron has historically had a very volatile, cyclical memory business in DRAM and NAND memory, and that business was sort of struggling. Meanwhile, they had developed this HBM chip, which is really used in AI servers, not just in the cloud, but it's actually these chips are used in what's going to be the next wave or cycle of AI PCs and AI phones. And so with that sort of exciting opportunity, after Micron basically corrected a little over 40%, we decided to start nibbling at it. And so far, so good. Again, this is another company that is in the first inning of their what I'll call their AI opportunity set. But not everything, but there's other things other than AI that have been going up. And one of our favorites that we've owned for years is the GLD, which is the gold ETF. This has been a remarkable outperformer. It's outperformed the NASDAQ and the S&P 500 by quite a bit. There is this interesting trend going on where global central banks are boosting their gold reserves in favor of holding more treasuries. Now, maybe this is because of the out of control fiscal spending we've had in this country, but that's certainly been a positive for demand for gold as it sets new highs. And it's also now benefiting from a weaker dollar. So that's been a good, I'll call it non-AI winner. And another good one has been AGNC, which has been a long time holding. We've talked a lot about that in the past. This is a mortgage REIT. They own agency RMBS securities. They own them on a levered basis. So far this year, it's basically kept up with the market on a total return basis. Very important to think about names like this that has a 14% dividend yield. You want to look at the price return, not just the price return, but also what those reinvested dividends have returned. Part of what's going on here is that with the Fed pivot to easing, lower interest rate volatility, and still very wide MBS spreads relative to history, this business is able to generate mid-teens economic returns, which obviously supports this robust dividend, but also provides some upside in the future if MBS spreads ever tighten up, which is possible. But we'll see when that happens. But so far, this has been a great, relatively uncorrelated contributor to returns. Now, now sort of stepping back, where are we in the calendar? We just exited what is September, which is historically the weakest month for the S&P 500. And so you can see in this graph, historically, September is down on average. This is looking at an average over the last 20 years. but is down on average 0.7%. And obviously, we are now entering into a year-end period that is historically pretty strong. So now that doesn't mean that necessarily the market is absolutely going up, but when you put it into context with lower interest rates and a still strong economy, that certainly does contribute to the notion that we could see markets rally into year end. So the key considerations going forward that we're thinking about, and this is just a sample of a few, but as I mentioned, we've got this next wave of AI winners. They really seem to be catching a bid. And there are others out there that we are spending a lot of time performing due diligence on. But after this big, deep pullback that many of them have experienced over the course of the last few months, we think there's probably an interesting opportunity to pick up a few more of these. There are definitely areas to watch out for in this market that are overbought. There are also areas that are still really struggling. I mentioned before that manufacturing continues to be a difficult area for this economy. There are other issues such as logistics and trucking and shipping. Their woes are being exacerbated by the longshoreman strike. Who knows how long that goes? But these are sorts of things that we are trying to watch out for and avoid at all possible, in portfolios. The Fed put that I mentioned, I think one of the interesting things about the Fed put is that it may enable more cyclical or value names to outperform. And I think that would be really healthy. As we go around and we look at, there's a lot of beaten up names out there, a lot of value-oriented names that really have just been overlooked because so much of the market for not just this year, but really for the last few years has been so focused on the Magnificent Seven and then artificial intelligence that there's a lot of really great companies out there that have just been ignored by market participants. And so this Fed put could actually help really enable us to kind of go after some of these more value-oriented names. And we think that maybe other investors will follow us. Obviously, one of the key questions that we're thinking about is how aggressive will the Fed be in cutting rates? Or maybe I should say, how aggressive will the Fed need to be in cutting rates? And that's obviously going to be highly dependent on how the economic data comes in. Just this morning, for example, we received the ADP payroll report, which actually beat expectations. It was up 143,000. Expectations were 125, and that's actually up sequentially as well. So that's not crazy robust, but it's a positive sign that things aren't falling apart in the labor market. We get obviously the actual non-farm payroll report this Friday, and so that's obviously going to give us another glimpse into what's going on in the labor market. So these are going to be key data points that we have to observe and include in our calculus as we go forward. The other big question is just, will these rate cuts be enough to prevent a downturn? So as I said earlier, the jury's still out whether the Fed has waited too long to cut rates. And there's definitely evidence in certain sectors that things are weakening. It hasn't, though, spread to the services part of the economy, right? The interesting thing, and we talked about this for the last few years, is that the economy has sort of gone through a set of rolling recessions that have hit various industries at different times. But one part of the economy that has sort of remained pretty weak has been the goods producing part of the economy, the manufacturing piece, and anything related to shipping around those goods has been quite weak now for several years. Meanwhile, the services side has remained pretty robust. I mean, even post kind of the readjustment that we had, post-pandemic back to going to services and, going out to eat and that sort of thing. Even in the face of dramatic inflation, the services part of the economy is still hanging in there pretty well. So we're watching that very closely to make sure that that doesn't fall apart either. But again, we don't know right now whether the rate cuts will be significant enough and fast enough to prevent a downturn and get back to essentially that neutral rate, because they still do remain quite restrictive. And then finally, there's obviously a lot of uncertainty around the election. And and it's not just the presidency, it's also who's going to control, which parties will control the Senate and the House. If you look at the betting odds, right now it indicates a split Congress. It looks like the Republicans will take the Senate and the Democrats might actually take back the House. Who knows how it actually works out? But that would be any sort of split Congress would be the answer that the market would really like the most. Generally speaking, the market performs best when essentially the federal government can't get anything done. And so, right now that looks like the base case. And so that could be supportive to markets going forward. But again, we're going to have to see what happens when the votes are all counted. But let me leave you at least with this point, is that it's very rare to be in this situation where the Fed is easing when the economy is not in recession. And so this really does create a favorable backdrop for this year-end rally that I was talking about. And let me finish with this last slide. It's a slide that I've shown you now for several months now, but there is so much money sitting on the sidelines waiting to come into the market. There's now $6.4 trillion sitting in money market assets. A month ago, you were earning 5.25% on that. Today, you're earning closer to 4.75%. If you look out a year, you might be earning 3% on that asset. What that means is that people are, our clients, your clients are going to have to start thinking about what are we going to do with this money? We've got to, now that it's earning less and less of a yield, it was really fun to collect 5.25% and take absolutely zero risk. That was great. But that is going to become not as good an option going, as rates decline over time. And so this could be a very big future tailwind for bonds and even for stocks. It also means that there's a lot, wrap this in with the whole notion of the Fed put. This means that any dips that we get in the future are likely or more likely than not to be bought. And so this is going to be something that's going to be very interesting to watch over the course of the next 12 to 24 months, is to see this huge unwind of money from these money market assets. So Tom, let me stop there and let's take some questions.
Sure. Great. Thanks, Jim. As always, thanks for your thoughts. I'd like to remind everybody that's on the call that has a question, please submit that to the Q&A box down at the bottom of your screen. The first question, Jim, is the market, the Fed, and the economy are all well and good. As you stated at the beginning of your presentation, most of the people I speak with are more concerned about the deficit. Do we need to cut government spending by a significant amount?
Well, I don't think there's any appetite on either parties, from either party to cut spending. It's pretty clear that there is an ability still to finance this deficit, and we have not reached the crisis point where either party looks willing to do anything about it. Now, that's not necessarily the right answer, and I think the deficit is a problem, and this is why we own a lot of gold, because if market participants start to lose faith in the U.S. Treasuries, for example, that's going to inure to the benefit of gold. But yeah, we would agree that deficits are a problem. Theoretically, they're a problem because eventually you have to pay your bills, and eventually taxes have to go up, and you have to cut spending. But in the meantime, deficits are great for markets, right? When you have basically deficit spending, what ultimately happens is that you are juicing the rest of the market. You're juicing the rest of the economy. And so in the meantime, it's a great party. And we all know that parties have to end at some point, and there could be a giant hangover at the end of it, but it's not going to happen tomorrow. And so we're just going to have to wait and see. Again, if rates keep falling, then financing the deficit becomes even easier, right? And so if there wasn't a giant urge to cut spending and start to deal with this deficit today when interest rates are high, there's going to be even less motivation by politicians to do anything about it if we go down 100 or 200 basis points in interest rates. So yeah, I mean, yeah, I feel similarly to your clients that, yeah, I'm concerned about the deficit too, but I don't think it's a tomorrow problem, or a today problem.
Got it. Thanks. One question that I get a lot from the folks that I work with, because the concept of being theme-based is unique, and we've done a really good job pegging some secular themes with significant tailwinds, which is reflected in our strong performance. But it doesn't look like we've added many new themes recently. And one of the questions that I get is, what is the PM team talking about in terms of where we might uncover other than the new wave of AI, where might we uncover a new theme for investing going forward?
Yeah, I mean, I don't necessarily agree that we haven't added any new themes. I mean, for example, we added defense names because we believe in the remilitarization globally that's going on. I think that probably came into play. We've probably launched that about 6 months ago. But again, these themes, they're in many cases they are decades long in terms of their duration, and so you don't need to invent a brand new theme every day, and so you aren't going to see radical changes as a result. But what happens more is evolution to these themes as much as anything else. So, for example, our electrification theme, as we were doing all this work on AI, we stopped and said, wait a minute, there isn't enough electricity being generated to feed all this stuff. And so that led us down this whole path. And so if you were to look across all of our portfolios, um, that's why we have things like copper. That's why we own uranium. Guess what? The whole rest of the world, and now we're starting to a little bit in this country, are building nuclear reactors to solve this energy problem. That's why, so there are a number of different themes that sort of spit out of this. How do you solve this problem of not enough energy? We also own we don't have enough data centers. So we own the guys that basically do all the cooling for the data centers and, help, with the actual guts of operating data centers. So very oftentimes you can take a theme and the more you explore it, it's sort of all these other side themes start sort of falling off and you can attack those. But yeah, I mean, it's not every day that we come up with a brand new theme, but we always thinking about it. I mean, I'm working on one right now that, again, is probably kind of a offshoot of the AI theme, but I think it's really cool. And, we're doing the work right now to get up to speed on it so that we can also then find the best way to play it. So it's just it's a constant process. We've talked a lot in the past about, India as a theme. We've been invested in there for years. We're always looking for new ways to play that. Japan has been an important theme. So, whether it's and even when we think about fixed income, we had this theme about adding duration. Well, that worked out pretty well. And so even though it may not be kind of a industry or type theme, the oftentimes when we see the direction of interest rates, we can make a judgment as to how long is that going to occur? How long is this easing cycle going to last? And where do you want to be to take advantage of that? So short answer is, even if it doesn't look like we're doing a lot on the theme side, we're always doing work on themes.
Great, thanks. That's helpful. Having to do with themes, one of the questions is how long or how many years do we think the AI theme will be an impact on the market?
That's anybody's guess. I mean, it's probably at least a decade. I mean, AI is probably the most important thing that's happened technologically speaking since the invention of the internet. And there's still lots of opportunities to invest in internet related businesses. So, what we haven't even begun to AI is we haven't even barely scratched the surface on the opportunity. I think a lot of people have agreed that where you're going to see AI really impact the economy is on productivity. I remember back to when Excel came out and people were like, whoa, you can build a spreadsheet. This is really, and you don't have to write it down on a piece of paper. And hand calc it. There's just so many potential productivity enhancing uses of AI that I just don't even think that we've even thought of a fraction of the opportunities. I mean, one of the things that we have in our portfolio is biotech. Biotech should be an enormous winner. It would just seem to me that AI should make drug discovery and development much more efficient, cheaper, faster, et cetera. And so what does that ultimately look like in 10 years? I have no idea, but it probably is pretty good. So yeah, I mean, I think it's really exciting. The whole, if you even just look at the electrification theme, I mean, this could go on for obviously decades, as electricity consumption accelerates. So yeah, I mean, that's principally what we're looking for is when we get into themes, we want these themes to be around for a while. These aren't just sort of fleeting, 1 or 2 year type deals.
Yeah, agreed. That question reminds me of the Oracle shareholder conference, right? That where Larry Ellison was talking about. Somebody asked him the same question about how long is AI likely to be, a strong theme to invest in, and he said, it's at least a decade, and it's here to stay. I mean, it's not a, it's affected so many other parts of the the world and the business the business community that it's not going away. So it's one likely that we're going to have in the portfolio for many years to come, I would think.
Mm-hmm. Yeah.
All right. So there is one more question here that is a little bit more tactical, and I don't know whether we want to address it on the call, but in general, if a client account doesn't have a lot of cash to deploy, how will we be taking advantage of dips in equities? Will that come from the fixed income portion of the portfolio, or will we raise cash in a different way?
Yeah, I mean, so everything's for sale every day. That's the great thing about the public markets. And so if there is a really great opportunity that we want to take advantage of, we will go through the portfolio. We will find, there could be a name that hasn't really worked, and there's a tax loss that can be taken. That might be the solution. You could take let's say we wanted to get a lot more aggressive in terms of equities. Yes, you could take from the fixed income piece, but you could also sell a lower beta equity and replace it with a higher beta equity. So we got a lot of different ways to sort of move this around, move the risk in the portfolio around, even when you don't have, oodles of cash sitting in there.
Got it. Great. Okay, Jim, we're right around 20 minutes to the hour. We like to try to keep these meetings, within 30 to 40 minutes. So we're right there at the time limit. Doesn't look like there are any new questions. So I want to thank you for your time. I'd like to thank everybody who participated in this call for your time. As a reminder, I'll follow up. Either Keith Durand or I, my colleague, will follow up and send out the client-approved recording of Jim's webinar and presentation. And as always, thank you very much for your trust in us, and thank you for the business that you enable us to help you with. And we'll talk with you again in early November. Thanks, everybody. Have a great day.
Great. Thanks, everyone. Take care.